Yeah, so when they invest, typically it's directly into the company. At this stage, you're putting money into the company, not into the owner's pockets. If a company later sells, yeah, that usually the owner, they're getting money into their pocket, or if they, recapitalize, take chips off the table, we call it. But at this stage, none of the money really goes into anybody's pocket. It goes into the company itself, so the company can reinvest that money and use it for rapid growth or scaling. But the way most of my clients, who are obviously very well advised, will do it, they understand that this money is going just to the company and is to be used for company purposes. However, these founders, the management team, yes, they are a very attractive and a very important resource for the company. So when an investor says, I'm investing in the management team, they're saying, the management team is more important to me, given their experience and track record, hopefully a successful track record, than just the new idea or the widget that they created. I'm investing in this tried and true team who know how to do it and have that record of doing it successfully and creating that return on investment for those investors. So when an investor invests, they are not looking to make you rich. They are not looking to see this company do wonderful things. They are doing it to get a return on that investment, full stop. So if they invest $1 million, they want to get several $1 million back. How they get that back and when they get that back, that matters, but they're not looking to improve the world necessarily. If they can improve the world and make money, great. But they are looking to make money. That's their sole job as a venture capitalist, as a private equity investor, is to get a return on that investment. If they don't get a return on that investment, they can't keep doing these investments. So the default for raising money is you go public, an IPO, a registered offering. But companies at the startup stage don't do that. First of all, nobody would invest in an IPO for a company that's pre-revenue pretty much. And instead, what they do is they go to the private markets. And if you're going to do a private offering or an exempt offering, then there's different buckets. There's different regimes that you can qualify for. Probably the easiest and most often used regime is raising money from accredited investors, and those are considered to be people who are wealthy enough to protect themselves, to hire their own tax advisors and legal advisors. People who can maybe suffer the risks of a speculative investment that has an 80% failure rate without being destitute and impairing their personal wealth too much. Or they have a level of sophistication. Maybe it's their day job to do this kind of stuff, so they can really protect themselves from a due diligence point of view. But these folks who are called accredited investors will be held. They have to protect themselves a little bit more. So, for example, if you raise money from people who aren't accredited, from a couple of retirees, and they're tapping into their retirement account, the law tends to bend over backwards to protect them. They don't want those people to lose their money in their house like they did during the Great Depression. So the laws are designed to really, really protect those types of individuals, the non-accredited investors. When you do stuff with accredited investors, you don't have to disclose as much. You don't have to put together a private placement memorandum every time with a slew of risk factors that explain to the investors why they're foolish to invest in a company as speculative as yours, which is basically what you have to do. Instead of saying, invest in me, I'll get you helicopter money, you basically have to say, if you invest in me, there's an 80% chance of failure. Now will you write me a check? Accredited investors are used to hearing that. They understand the risks a little bit better, at least they're supposed to. And so for that reason, just offering and just accepting money from those that are accredited investors is usually a much safer and a less expensive compliance requirement than going to other friends and family who may not be accredited investors themselves.